42 years old. You open your 401k. $58,000. Not enough. So your financial advisor says, keep buying the S&P 500. Just hold for 30 years. But that advice is mathematically broken. $10,000 in the S&P 500 10 years ago is worth $24,000 today. The same $10,000 in Bitcoin is worth $3.8 million. Here's why that gap exists. Okay, let's start simple. $10,000. May 2015. 10 years ago. You had two choices. Door number one, the S&P 500. Boring, safe, the classic. Door number two, Bitcoin. Weird, volatile. Most people thought it was a scam back then. So what happened? That $10,000 in the S&P 500 over the last 10 years, with dividends reinvested, would be worth around $24,800 today. That's almost a triple. Honestly, that's a great return. Most investments don't do that. Now the same $10,000 in Bitcoin. Same starting date. $3.8 million. Yeah, $3.8 million. And before you accuse me of cherry picking, I checked. The same comparison on 5 years, 7 years, 15 years, the pattern doesn't change. Bitcoin wins by orders of magnitude. Every single time frame. But here's what I want to show you, because honestly, the dollar amounts are not even the most interesting part of this story. The most interesting part is what the S&P 500 has actually been doing this whole time, and it's something almost nobody talks about. If this is already useful, drop a like. It helps the channel reach more people who need to see this. Now let me show you what the S&P 500 is really doing. The S&P 500. 500 companies, the biggest in America. Sounds diversified, right? Here's the part where I have to ruin that for you. The top 10 stocks in the S&P 500 now make up roughly 40% of the entire index. 40 cents of every dollar you invest goes into 10 companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, Broadcom, Berkshire, JP Morgan. That's it. 500 names on the box, 10 on the stage. And the Magnificent Seven alone, just those 7 tech giants, they're 34% of the index, up from 12% 10 years ago. To put that in perspective, at the peak of the dot-com bubble in 2000, the one that crashed the market for 3 years straight, the top 10 companies only made up about 27% of the index. We are more concentrated today than at the worst peak of the worst tech bubble in modern history. Oh, and one more fun fact. Of the 500 companies that were in the S&P 500 back in 1970, 86% of them are gone, bankrupt, bought out, dropped from the index. The S&P 500 has quietly rebalanced you out of dozens of disasters over the years, but it also means you've been holding a lot of losers along the way. Now look, I'm not saying the S&P 500 is bad. I want to be honest with you. For someone who started investing at 25 and has 40 years of compounding ahead, it's a totally reasonable strategy. But the real problem with the S&P 500, the one that no one tells you about, has nothing to do with concentration. It's much weirder than that, and it's coming up in about 30 seconds. Okay, so here's the thing. The S&P 500 has returned about 8% per year over the last 54 years. That's the headline number, 8%, compound interest, etc. Sounds good, right? Here's what almost nobody tells you. Over those exact same 54 years, the total U.S. money supply, the M3 measure, the count of how many dollars exist in the system, has also grown at about 8% per year. Let that land for a second. The S&P 500 didn't actually make people richer. It just kept pace with the dollar getting watered down. When you invest in the S&P 500, you're running on a treadmill. The numbers on the screen go up. Your real purchasing power, what those dollars actually buy in groceries, in rent, in healthcare, barely moves. Most financial advisors don't tell you this. Not because they're hiding it, because most of them have never done the math. The math is just inconvenient. So here's the question you should be asking right now. If the S&P 500 is just tracking the money supply, what kind of asset would actually escape that? That's where Bitcoin gets interesting. Bitcoin is not interesting because the price keeps going up. Plenty of things go up. Bitcoin is interesting because of one mathematical property nothing else has. 21 million. That's the total number of Bitcoins that will ever exist. No central bank, no committee, no government, no congressional vote. Nothing can ever create more. The number is hard-coded into the protocol forever. Now compare that to the dollar. Since 1971, when the U.S. officially abandoned the gold standard, the dollar has lost roughly 88% of its purchasing power. $1 in 1971 buys about 12 cents of stuff today. That's not opinion. That's the Bureau of Labor Statistics. It gets worse. Between January 2020 and December 2021 alone, just 23 months, the total U.S. money supply expanded by 39%. In less than 2 years, they printed almost 40% more dollars on top of everything that had ever existed. That's not a conspiracy theory. That's a Federal Reserve data point. So you've got a dollar that's designed to lose value over time, an S&P 500 that just keeps pace with that loss, and one asset, Bitcoin, that mathematically cannot be inflated. Now, here's what's new. Because for years, Bitcoin was a thing for libertarians, programmers, and weird internet people. That changed in the last 24 months, and most people haven't caught up yet. January 2024. The SEC approved the first spot Bitcoin ETFs in U.S. history. Today, the iShares Bitcoin Trust from BlackRock, ticker IBIT, holds about 771,000 Bitcoins worth roughly $70 billion. Larry Fink, the CEO of BlackRock, used to call Bitcoin an index of money laundering in 2017. Today, he calls it modern-day gold and an asset of fear. And Michael Saylor's company Strategy, used to be MicroStrategy, has bought roughly 640,000 Bitcoins for its corporate treasury. The stock is up around 2,000% over 5 years. So if you've been thinking Bitcoin is still that weird thing for crypto bros, you missed the memo. The biggest names on Wall Street are now buying it as fast as they can. And I know what you might be thinking right now. You're probably thinking, okay, sure, but I'm 40. Isn't it too late? That's exactly the next part. Okay, so here's the part where I'm going to break the fourth wall a little bit, because I owe you the truth about why I'm even making this video. I'm in my 40s. Like most people watching this, I didn't grow up rich. I worked. I saved when I could. And a few years back, I sat down and did the same math I'm doing with you right now, and I realized something that honestly bothered me for weeks. The strategy I'd been told to follow my entire adult life, index funds, just hold, don't think about it, was mathematically designed to keep me in place, not to make me rich, just to keep me running on the same treadmill as the dollar. So I started studying. I read everything I could on Bitcoin, the bull case, the bear case, the math, the history, and I built this channel because I couldn't find anyone speaking honestly to people like us. People who started late, people who don't want hype, people who just want the real numbers. Because here's the thing. If you're 22 and you start investing in the S&P 500, you have 40 years of compounding ahead of you. That works. The treadmill problem matters less when the treadmill runs that long. You'll be fine. But if you're 38, or 42, or 45, sitting on 30,000, 50,000, maybe 100,000 in savings, looking at 20 years until retirement instead of 40, the math gets brutal. Tracking the money supply for 20 years doesn't catch you up. It just preserves the little you already have. And that's the conversation nobody is having on YouTube. Everyone is either talking to 20-year-olds about index funds or talking to crypto millionaires about their Lambos. Nobody is talking to the person who started late and needs a different math. So let me give you that math now. And let me tell you about a kid who saw all of this clearly when he was 12 years old. Story 1. Eric Finman. May 2011. He's 12 years old. His grandmother gives him $1,000 as a gift. Bitcoin is trading at around $12 per coin. He buys about 100 Bitcoins. At 12 years old, he could have spent that money on toys, video games, anything. Instead, he saw something his parents, his teachers, every adult around him completely missed. Those 100 bitcoins alone today are worth roughly $10 million. Eric became a millionaire at 18. Story 2. Changpeng Zhao. Most people know him as CZ. He runs Binance. 2014. He sells his apartment to buy Bitcoin. His apartment. That kind of conviction is hard to find. Today, his net worth is north of $60 billion. The lesson isn't sell your apartment. The lesson is, some people saw it early, and they didn't hesitate. Story 3. Laszlo Hanyecz. This one hurts. May 22nd, 2010. He pays a guy 10,000 bitcoins for 2 pizzas. 2 pizzas. At today's prices, those 10,000 bitcoins are worth around $1 billion. The most expensive pizzas in human history. He had Bitcoin in his hands. He just didn't see what it was. Most people never do. Story 4. Jared Kenna. This story has 2 parts, and it's important. Jared bought Bitcoin at 20 cents. Yeah, 20 cents. He sold a bunch at $258. He made millions, but if he had held just a few more years, he would have made 100 times more. And then, bonus disaster. He accidentally formatted a flash drive containing more Bitcoin. Gone. Forever. If you're worried about losing your Bitcoin like Jared did, or like James Howells in Wales, the guy who threw away a hard drive with 7,500 Bitcoins in it, worth roughly $800 million today, now buried in a landfill that the city refuses to let him dig up. Here's the good news. That was 2011 and 2013. Today, you can hold Bitcoin in IBIT, BlackRock's ETF, inside your normal brokerage account. No keys, no drive. Same exposure. The "I lost my coins" problem is now optional. Story 5. The hidden math of who actually made it. According to the 2024 Henley & Partners Crypto Wealth Report, there are roughly 172,000 crypto millionaires in the world. 85,000 of them got there on Bitcoin alone. And here's the kicker. In just the first 6 months of 2025, more than 26,000 new people crossed the Bitcoin millionaire mark. That's not 2017. That's not the early days. That's right now. The institutional phase is just starting. If you think the train left the station, you're looking at the wrong train. All right. Before we go further, let me be straight with you. If you've been listening, you've been thinking about the objections, so let me deal with them. 5 of them, quickly, honestly. 1. Bitcoin is too volatile for someone close to retirement. True. If you're retiring in 5 years, putting your savings in Bitcoin is a terrible idea. The volatility will eat you alive. But if you're in your 40s, with 20-plus years of horizon, short-term volatility matters less than long-term compounding. And nobody is saying go all in. 5 to 10% of your portfolio is a completely different conversation. Even Bank of America and Morgan Stanley now tell their wealth clients 1 to 4% is reasonable. 2. What if I lose my keys? Real risk in 2013. In 2025, you can hold Bitcoin in IBIT, the BlackRock ETF, inside your Fidelity or Schwab account. No keys, no drive, no problem. Self-custody is a choice now, not a requirement. 3. Warren Buffett called it rat poison squared. He did. Larry Fink, the CEO of BlackRock, called it an index of money laundering in 2017. Today, his firm holds 771,000 bitcoins. People change their minds when the math changes. 4. I'm too late. I missed it. I already showed you. 26,000 new Bitcoin millionaires in just 6 months of 2025. The institutional buyers, ETFs, sovereign reserves, corporate treasuries started accumulating less than 2 years ago. If anything, you are early to the part of the story that matters now. 5. The government is going to ban it. Trump signed the Genius Act in July 2025. The Clarity Act is working its way through the Senate. Spot ETFs got approved by the SEC. The trajectory is the opposite of a ban. That doesn't mean zero regulatory risk. It means the worst-case scenario keeps getting more unlikely every year. Okay, now let's do the parts you've been waiting for. The numbers. Back to our 42-year-old. $58,000 in the 401k. 20 years to retirement. Let's do the math two ways. Scenario 1. A single $10,000 lump sum. In the S&P 500, at 10% annualized, which is the historical average over 20 years, about $67,000. In Bitcoin, at a conservative 25% compound annual growth rate, and I want to be clear, that's a quarter of the rate Bitcoin has actually returned over the last 10 years. Over 20 years, about $867,000. Even at a fraction of the historical return, the gap is 12 times. Scenario 2. $500 per month, every month, for 20 years. In the S&P 500 at 10%, about $382,000. In Bitcoin at 25% compound, about $1.6 million. $500 a month, 20 years, millionaire status. But, and this is important, only if the math holds, and only if you can stomach the ride. Past performance is not future performance. Bitcoin could crash 80% next year. The S&P 500 could outperform Bitcoin over the next 20 years. Nobody knows. What we do know is what the math says today. And the math is different from what your financial advisor will tell you. Remember that 42-year-old at the start of the video with the $58,000 in his 401k? Maybe that's you. Maybe it isn't. Here's what I want you to take away. I'm not telling you to sell your S&P 500 and put everything in Bitcoin. That would be irresponsible. I'm telling you that the S&P 500 has been tracking the dollar's debasement for 54 years. The math is different now. And whether you do anything about it, that's on you. If this video helped you think about your money differently, even a little, hit the like button. It tells YouTube to show this to more people who need to see it. Subscribe to the channel and click the bell so you don't miss what's coming next. This channel is being built specifically for people in their 30s, 40s, and 50s who started late and want a real plan, not motivational fluff. And speaking of what's next, the number one question I get is, okay, fine, but how much Bitcoin should I actually own? Bank of America says 1 to 4%. Fidelity says 2 to 5. Rick Edelman says 10 to 40. They can't all be right. In the next video, I'm going to break down, by age, by net worth, by risk tolerance, exactly how to allocate between Bitcoin, the S&P 500, and cash if you're 30, 40, or 50. With the real math. No hype. Subscribe so you don't miss it. See you in the next one.